It is January 25, 2026. While you were watching the S&P 500 hit new highs or stressing about the latest tech earnings, something critical just snapped in the engine room of the global economy. We usually think of central banks as these boring, monolithic temples of stability. Men in gray suits, speaking in riddles, moving interest rates by 1/4 of a point. Boring, right? Wrong. Right now, across the Atlantic, the Bank of England, the old lady of Threadneedle Street, the model for central banking for over 3 centuries, is tearing itself apart. We are talking about a full-scale corporate coup, a massive purge of senior leadership, and a desperate scramble to fix a broken machine. Why? Because they failed. They failed spectacularly. Remember 2022? Remember transitory inflation? Remember when they told us price hikes were just a blip, and then your grocery bill doubled? Well, the bill for that incompetence has finally come due. The Bank of England is currently executing a brutal restructuring, effectively stripping power from its chief economist and handing the keys to a new Iron Lady of Finance, Deputy Governor Claire Lambertelli. They are firing staff, morale is in the toilet, and they are admitting, publicly, that their economic models, the math they use to decide the value of your money, were fundamentally broken. If you think this is just a British problem, you are dead wrong. This is a canary in the coal mine for the Federal Reserve, the ECB, and the Bank of Canada. If the Bose models are broken, everyone's models are broken. Today, we are diving deep into the chaos in London. We're going to look at the Bernanke Bombshell, the internal power struggle that looks more like an episode of Succession than a government meeting, and most importantly, what this chaos means for the US dollar, global stock markets, and the assets sitting in your 401k right now. Buckle up. The adults have left the room. Let's rewind the tape. To understand why heads are rolling in London today, in 2026, we have to look at the crime scene of 2021 and 2022. Global inflation didn't just happen. It was allowed to happen. Central banks, led by the Federal Reserve and the Bank of England, fell asleep at the wheel. But the Bank of England's failure was special. It was catastrophic. While inflation was raging toward double digits, the Bose forecasting models, these incredibly expensive, complex algorithms, were predicting a gentle breeze. They were blindsided. When the cost of living crisis hit the UK, it hit harder and lasted longer than almost anywhere else in the G7. We're talking about regular people choosing between heating their homes and eating dinner. The public anger wasn't just about the prices, it was about the surprise. The central bank is supposed to be the lookout tower. If the lookout is playing Candy Crush while the barbarian horde is burning down the village, you don't just buy better binoculars. You fire the lookout. The humiliation was so deep that the Bank of England did something unprecedented. They called in an outsider to audit them. And not just any outsider. They called in the heavy artillery, Ben Bernanke. Yes, that Ben Bernanke. The former chairman of the Federal Reserve. The man who steered the US through the 2008 financial crisis. For the British establishment, having to ask a Yank to come over and grade their homework is the ultimate embarrassment. It's like Ford asking Toyota how to build a reliable engine. Bernanke's review was released a while back, and it was scathing. He didn't just say they made a mistake, he said their entire infrastructure was obsolete. He criticized their forecasting software, their communication style, and their lack of diversity of thought. Translation? You guys are an echo chamber running on Windows 95, and you have no idea what's happening in the real world. That brings us to today, January 2026. The Bernanke shockwave is finally hitting the organizational chart. The bank has been forced to admit that their staff, their structure, and their tools are not fit for purpose. This isn't a tweak. This is a demolition. Here is where the story gets juicy. This isn't just about charts and graphs, it's about power. According to leaks coming out of the bank today, Deputy Governor Claire Lambertelli is executing a massive power grab. She was put in charge of the Bernanke reforms, and she is using that mandate to consolidate control. The bank is hiring a new executive director. This person is going to oversee 300 staff members. That's a huge army in the world of economics. This new director will handle monetary analysis and strategy. But here's the kicker, this new role reports to Lambertelli. Who loses out? Who pill? Who pill is the chief economist. In the old world, the chief economist is the rock star. They are the ones who supposedly know everything. They manage the analysts, they write the forecasts, they vote on rates. Under this new structure, Pill is being stripped of his empire. The reporting lines are being severed. He will no longer directly manage the army of analysts that crunch the numbers. One insider called the previous arrangement unusual, but let's be real, stripping a chief economist of his research staff is like telling a general he can keep his rank, but he's not allowed to talk to the soldiers anymore. The official statement from the BOE is filled with corporate fluff. They said this removes a long-standing tension between the chief economist's voting capacity and management responsibilities. Let me translate that from central bank speak to Wall Street real talk. They are saying, you messed up the inflation call. We don't trust you to manage the team anymore. You can keep your vote, you can sit at the big table, but Claire is running the show now. This is a quiet firing. A demotion in plain sight. And it's creating a toxic environment. Reports are flooding in that staff morale at the Bank of England has collapsed. They are doing a cost-cutting drive at the same time they are trying to fix their broken models. Think about the insanity of that. You admit your technology is broken and your forecasts are wrong. You need to upgrade everything. So what do? You invite your employees to volunteer for layoffs. It's madness. They are bleeding talent exactly when they need it most. They are bringing in expensive consultants to implement the Bernanke upgrades while firing the people who actually know how the plumbing works. We need to take a minute to understand why Bernanke roasted them so hard, because this directly affects your portfolio. Central banks use models called DSGE models, Dynamic Stochastic General Equilibrium. It sounds fancy, but here's the dirty secret: these models assume the economy basically wants to be stable. They assume that if something bad happens, everyone acts rationally and things eventually drift back to normal. These models were built for the Great Moderation, the quiet period from 1990 to 2019. They were absolutely useless for 1. A global pandemic. 2. A war in Europe. 3. Supply chain fractures. When the price of natural gas spiked in 2022, the Bose computers looked at the data and said, "Does not compute. This will go away in 3 months." Real people knew it wouldn't. The computers didn't. The restructuring happening right now is an attempt to fix this. The new job posting for the executive director role explicitly calls for driving cultural change and diversity of thought. Diversity of thought is code for we need people who don't just worship the same broken mathematical models. They need contrarians. They need people who understand the real world of supply chains, geopolitics, and energy markets, not just academic theories. But here is the danger. You are trying to rebuild the engine of a Formula One car while driving it at 200 miles per hour. The UK economy is fragile. If this restructuring causes confusion, or if the new team overcorrects, they could drive the UK into a deep recession. And in a globalized economy, when a G7 nation crashes, it sends shrapnel flying across the Atlantic. Okay, I can hear you asking, I live in Chicago, or Toronto, or Miami. Why do I care if Who loses his staff in London? Here is the wallet connection. 1. The currency contagion. The British pound is one of the most traded currencies in the world. It is a reserve currency. When the Bank of England looks unstable, the pound gets volatile. If you own any international index funds, any total market ETFs, you own UK stocks. Unilever, Shell, AstraZeneca, HSBC, these are giants. If the bull mishandles this transition and the pound crashes, the value of those holdings in US dollar terms fluctuates wildly. Volatility in the FX market spreads. It spikes the VIX. When the VIX spikes, algorithms sell off US tech stocks. It's all connected. 2. The Fed mirror. The Federal Reserve in the US is watching this like a hawk. The Fed uses similar models to the BOE. If the BOE admits their models are trash and restructures, the pressure mounts on Jerome Powell and the Fed to do the same. We could see a crisis of confidence in central banking itself. If investors start believing that the Fed is just as blind as the BOE, long-term treasury yields will spike. Why? Because you demand a higher return to lend money to a government that doesn't know what it's doing. If US Treasury yields spike, mortgage rates in the US go up. That house you want to buy gets more expensive because of a restructuring in London. 3. The liquidity trap. The BOE is cutting costs. They are shrinking their balance sheet. When a major central bank pulls back liquidity, it removes grease from the gears of the global financial system. We saw this in late 2022 with the UK pension fund crisis. The BOE almost broke the global bond market. The US Fed had to set up swap lines to save them. If this new leadership team, under Lombardelli, decides to get tough to prove their credibility, they might over-tighten rates. A crash in the UK bond market will affect US treasuries. It's a mechanism called sympathetic repricing. Wall Street sees London bleeding and starts selling New York just to be safe. So, where do we go from here? It's 2026. The shakeup is happening. What are the scenarios? The bull case. Claire Lombardelli succeeds. She builds a new team that isn't afraid to challenge the consensus. The BOE adopts AI-driven forecasting that uses real-time data instead of outdated surveys. The UK stabilizes. Inflation is tamed without crushing growth. The pound rallies. This creates a safe haven partner for the US dollar. Global markets calm down. Investment flows back into London, lifting the FTSE 100, and by extension, global indices. The bear case. This is the scenario that keeps me up at night. The restructuring turns into a civil war. The cost-cutting drives away the few smart people left at the bank. The new executive director clashes with the diminished chief economist. In this confusion, the bull misses another signal, maybe a resurgence of inflation due to a new geopolitical conflict, or a deflationary spiral. They react too late. The UK enters a stagflationary depression. Investors flee UK assets. The pound hits parity with the dollar. The contagion spreads to US banks that have exposure to UK debt. JP Morgan, Goldman Sachs, they all take a hit. The S&P 500 corrects 10% on global growth fears. The wildcard case. If the Bank of England continues to fail, the UK government might step in. This is the ultimate taboo. Central bank independence. If politicians start dictating monetary policy because the bank is incompetent, we enter a new era of fiscal dominance. If the UK does it, US politicians will start clamoring to control the federal. Once politicians control the money printer, inflation becomes permanent. They will print to buy votes. That is the death knell for fiat currency purchasing power. The restructuring of the Bank of England isn't just HR gossip. It is a symptom of a much larger disease. The era of the omnipotent central banker is over. For 30 years, we trusted these people to control the temperature of the economy with a dial. We thought they had a supercomputer that told them exactly what to do. Then Bernanke pulled back the curtain and showed us the truth. They are using broken calculators, they are fighting over office politics, and they are just as confused as the rest of us. So, what do? 1. Diversify away from policy risk. Don't bet your entire retirement on the idea that the Fed or the BOE will save the markets. They might not be able to. Hold assets that have value regardless of what a bureaucrat in London or DC decides. Hard assets. Real estate. Commodities. Gold. Bitcoin. Things that cannot be restructured away. 2. Watch the pound sterling to US dollar pair. Keep an eye on the pound. It is the barometer for this transition. If you see the pound sliding against the dollar while the BOE is talking tough, it means the market doesn't believe Lombardelli's new team. That is your signal to get defensive in your stock portfolio. 3. Question the narrative. When the Fed or the BOE releases their next forecast, treat it for what it is, a guess. A guess made by an organization currently undergoing a nervous breakdown. Do your own research. Look at corporate earnings, look at shipping data, look at what companies are actually saying. The old lady of Threadneedle Street is getting a facelift, but the surgery is risky, and the patient is unstable. The year 2026 is shaping up to be the year we find out if central banks can actually learn from their mistakes, or if they are doomed to repeat them. And as always, your wallet is the one on the line. Thanks for watching. If you want to stay ahead of the global financial chaos, make sure you smash the like button and subscribe. I'll see you in the next one.